Hi everyone, welcome to our very first video on a dividend stock that was requested by you. We ran the poll on Instagram and Visa was the company that you wanted me to cover, so let's get into it. Just a quick disclaimer before we get started that I'm not a financial professional of any kind and this is not a recommendation to buy or sell any shares. Make sure to read the disclaimer in the comment in the notes below as well. All right, let's get into it. So Visa is a global payment company. They help service payments from all around the world pretty much. So they have more than 3 billion Visa accounts around the world, and it's accepted in more than 200 countries and territories. So truly a global company, very well-known brand. You know, if you go with your Visa card to pretty much everywhere in the world, it's a trusted brand. You can pay with it, and that's sort of what creates a huge moat for it as well, because companies know that a lot of people have Visa cards, so they want the payment networks to be able to handle payments through Visa. And in 2019 alone, more than 200 billion transactions were made on the Visa network. Very impressive figure. And what's even more impressive is that the total value of these transactions amounted up to more than $11 trillion. So really hard to wrap your head around these large figures. So Visa is pretty much like the middleman in here. You know, they got different players here. You know, the people that pay for stuff using the Visa card. You have the businesses that use it to accept payments. You know, you have the financial institution that issue the cards, and you have the banks that obviously help make the transaction between the players here as well. And Visa is kind of like in the middle of all of this here. I like to think of Visa kind of like a toll collector. You know, they get a fee for all the business that gets made here. A lot of people actually think that Visa is a credit card company and it makes money on the credit card interest, and that's not the case. Visa is kind of the middleman here. The banks are the ones that handle the credit cards with the interest and all that. But truly a great company. You know, they've grown very fast as more and more payments are made using your card. You know, people don't use cash as much anymore. It's been a huge tailwind for the industry, and Visa and MasterCard are two of the biggest players in there with very strong positions. And if you look at the last decade, Visa's revenue grew at 11.5%, you know, compounded annual growth rate. And if a company can manage to do that over a decade to grow in double-digit figures, that's very impressive already. But what's even more impressive is the free cash flow per share growth. You know, the compounded annual growth rate over the last decade was 22%. You know, if you look at such a long time frame, and the free cash flow per share is compounded so fast. Obviously, it's helped by buybacks as well, as the company has used some of the cash to buy back shares. So that's kind of making the per share figures look better. But let's have a look at these how they make money. You know, this is a figure they shared in the 2019 annual report. You see this three large segments here. You know, there's some other revenues as well, but mostly it's the service revenues, which is, you know, the revenue made from the services Visa provides to the card issuers. There is the data processing revenue. So this is pretty much like a small fee that Visa collects on every transaction made, you know, because there's a huge network that they have to maintain, and Visa, you know, gets money when people access that payment network. And the third segment is international transaction revenue. So this is revenue from payments made internationally, and, you know, the currency exchange as well. It's like if you go on abroad with your Visa card and you pay in another currency, that's Visa makes some extra money on top of that as well. Let's run it by our dividend investing checklist. This is a checklist that most of you probably already have. It's what newsletter subscribers get when they sign up. It's totally free. If you go to dividendathlete.com and sign up, you get get notified first of some of my investments and just some insights that I share there. So let's run it Visa by all the criteria that I personally use. You know, this is not a recommendation of any kind. It's just what I personally use to to cover companies. So let's have a look at profitability first, because I think that's where Visa truly excels. I took some 10-year average figures just to kind of make it a little bit more conservative, because some very impressive figures here already, but just to kind of get a conservative look at Visa's profitability. Return on invested capital was 22%, which is well above my criteria of 12%. Return on equity was 17% on average over the last decade, which is above my criteria of 12% as well. And last but not least, the free cash flow as a percentage of sales was 42%, which is much higher than my criteria, and it's really very high figure. This is, when you analyze companies, not often that you come across such a high figure for free cash flow as a percentage of sales. So this is pretty much, when Visa makes $1 in revenue, 42 cents of that revenue, it will be free cash flow. So that's going to be 42 cents that they don't need to run the business or to pay for its expenses. That's going to be like left over. They can do with that free cash flow what they please. They can acquire other companies like they have been doing. They can pay down debt if they want to. They can pay dividends and grow dividends like they have been, or they can buy back shares, which they've been doing as well. All very impressive figures here, and that definitely checks out on my profitability criteria. Next, let's have a look at balance sheet. Crucial to have a look at balance sheet, especially in times like this when too much debt can cause problems for companies, as we have seen. Some companies cutting dividends now and struggling and having to issue debt on really bad terms because they already have too much debt on their balance sheet. So I think really crucial to have a look at that. We have a video on how to analyze balance sheets, using some really simple terms, if you want to check it out as well on this channel. So debt to equity, debt to EBITDA, and interest coverage are the three ratios that I look for here. And if you look at Visa's debt to equity, it's 0.47, which is well below, well, not well below, it's just below our criteria of 0.5, but it all checks out. If you look at the other figures here, it's going to give an overview actually how strong Visa's balance sheet is. Debt to EBITDA is 1.09, which is below my criteria of 3. So this shows that if Visa wanted to, they could pay off almost all their debt in like a year. So no problem whatsoever to finance their debt. If you look at interest coverage as well, the interest coverage on Visa of Visa's EBIT. So this is, if you want to check the balance sheet video, how that's calculated, go and check that out on this channel. But from Visa's EBIT, so earnings before interest and taxes, they can pay their interest payments more than 33 times over from that amount. So that's truly very impressive, and there's no concerns whatsoever about Visa's balance sheet. It's really a fortress balance sheet. My interest coverage criteria is usually above 8, so 33 is very, very conservative, and it all checks out here. Now let's have a look at some other metrics where it doesn't really check out according to my checklist. It doesn't say that it's a bad investment, but just how maybe that's not the best investment for me personally. Now, if you have a look at valuation, these are the ratios that I personally judge it by. Price to earnings is 33. My criteria is below 15. Price to free cash flow is 32, which is, way too high for me personally, as I look for price to free cash flow of under 15. Cyclically adjusted PE ratio is 65. So this is the PE ratio over the last decade, that's been adjusted for inflation as well. And that's 65, that's way too high, because for me personally, as my criteria is below 20. Just some context here, that 5-year average for Visa is 34 on PE, and the 5-year average for price to free cash flow is 30. So just a bit of context here, that although it's expensive for me, but on an average basis, it's pretty much in line for what investors have been willing to pay for shares of Visa over the last 5 years. So it's not, at the rally that we had, it's not even below its 5-year average on a free to cash flow basis, and pretty much in line with P to E PE. But for me personally, way too high. But just to give you a little bit context, it's how Visa is always trading at a high multiple, but it just doesn't check out for me personally. Just a little bit about how this high valuation comes to be. If a company is growing its earnings very fast, like Visa has been, then investors are willing to buy this stock at a higher valuation because they expect the growth to keep going as it has been, and that drives the stock price up and valuations up. But it also comes with high expectations. Investors are willing to pay a lot per dollar of earnings because they expect Visa to keep growing at this high pace. And if that, for some reason, it doesn't pay out, maybe Visa is not growing, it's still growing, but not growing as fast as people expected. It starts to slow down a little bit, as business is still performing well. There's not a problem on a business level, but investors will not be willing to pay such a high multiple for it anymore because the growth is not the same as they were expecting anymore. So that's valuation risk, which can drive the stock price down if it looks like, oh, well, Visa was growing rapidly, we saw the figures, they're growing revenue and free cash flow on very impressive level. But if the growth slows down, well, people are not going to pay these high multiples for it anymore, and that's valuation risk. And finally, let's have a look at dividend. There's something that's probably most important to me because this is what my investing plan and goals revolve around. I run some figures here, some calculations, and the blue line is Visa's current dividend yield of 0.65, and we took its historic dividend growth rate, which is, over the last decade, which was 24%, extremely fast, but the current yield is low because the share prices keep going up for Visa, which is, not exactly a problem for shareholders, but if you want to buy now, you're not going to get a lot of dividends for your money. And on the orange line, we have 3% yielding stock, and the dividend here is growing at 8% per year. And in this calculation, I assume that all dividends are reinvested. Now, me personally, I want to retire on dividend income in 6 years. So I'm looking at stocks and maybe yielding a little bit more already because I don't have so much time to wait until I need to use the dividend income to live off, and even if, Visa keeps growing at such a high rate, its dividends, which I think it's going to be extremely difficult to do, it will take them 15 years to provide more income than the 3%er that's going at 8. So in my personal situation, if I want to retire in 6 years, Visa would give me less than 2% on my investment, that would be less than 2% dividend income. That's not a lot. Whereas on the orange line, there's a company that's yielding 3% right now. It's growing slower, but it's still growing. And in year 6, it would give me a 5% yield on cost. That's obviously accounting for reinvesting as well, but that's the kind of income that is already meaningful for me. And, that's more for me personally. I'm not saying that Visa is a bad company. As we saw, it's an incredible company, but it's just not the best investment for me on dividend income. And let's just discuss some risks as well. We talked about valuation risk. If the expected growth doesn't materialize, investors are not going to be willing to pay the same multiple for it anymore. So that's gonna put downward pressure on the stock price. There's also the coronavirus in the short term. That's less and less transactions are being made on the Visa network. Visa is making less money, but as looks like economies are opening up again for business, and I don't think it'll be a big hit for Visa in the long run. This year maybe it's not going to look as good as it has previously when it comes to growth, but I don't think that will affect Visa much in the long run. Maybe people will want to pay with cards even more and use cash less. And finally, there's some competition as well. The fintech sector is pretty hot industry right now. A lot of up and coming companies, as it's a very profitable industry. That's where, you're going to get your entrepreneurs who are going to try and bring out new products to compete with existing ones. But I think Visa and MasterCard have such a strong position in the industry. It's going to take something, really groundbreaking to break up that duopoly. But maybe in the international segment, we talked about this. It costs a little bit probably more to use your usual card than it does compared to some other options out there. But that's the only way that only segment where I can see some competitors taking some market share. But Visa is also making acquisitions as well to keep up to date and with all the technologies, and that's going to help them grow as well. We just look at the latest transaction of Plaid, and I think they paid something like 5.3 billion for it, and that's a company that connects your financial accounts with the financial apps that you use. So that's another, that's going to give a Visa a great position there as well. And they've made a lot of acquisitions. They're not resting on their laurels. They're actively incorporating these smaller businesses into their ecosystem. So they're doing very well. In summary, as we saw, it's extremely profitable company by all metrics, high growth. It's been going on an absolute basis and a per share basis rapidly over the last decade. Very wide moat. Really only them and MasterCard in this space. They are the big players, maybe to PayPal to a certain extent, but I really see that Visa with its global brand as well, and I don't see anybody really competing with them in the near future, in my opinion. But you also have to look at all this quality and all this growth is kind of baked into the valuation already, and if it doesn't materialize, maybe there's some problem there. If you expect Visa to grow at 50% every year and it starts to grow at 14, 13, 11, 10%, that maybe investors will not be willing to pay this high of a multiple for it anymore, and that can bring the share price down maybe a bit, but for the business it doesn't really affect them. And for me personally, like I said, the low dividend yield means that it's not for me. I need more income in about 6 years, so it's not for me. That's, I think, what people don't understand when they're asking me about what about this stock, what about that stock, and I give them the answer, well, just, I don't know, just invest in accordance with your investment plan and goals. People often be like, well, isn't a good company is a good company, what do you talk about? But it's just an example of how really you should be looking at your goals first. My goal, I need quite high yield. There's not a high yield. It's not like an excessive yield, but I need a higher yield on my investment than some, for example, the S&P 500 is offering. I need a higher yield on the investments that you see, like on Visa, that are growing fast. The share price has gone up with them, so they're offering a low yield. I'm looking for a little bit higher yield. For me personally, doesn't mean that Visa is not a great company. It absolutely is, but it just doesn't fit my personal goals. Had a lot of fun making this video for you guys, and if you have any questions, this is where you can contact me. A lot of you guys write to me on Instagram. That's fine. On email, and on my blog, I can be reached as well. And just let me know if you enjoy this video. Make sure to like and subscribe, so I know that you guys like this type of content. So I will be bringing out more of that. Wish you all successful investing.